All right, guys, as promised, video number two, part two, more on annuities. It actually includes more than just annuities, but that's the focus. So, this one's going to take a while, so well, let me get my calculator. All right, a couple wishes to borrow money using the equity in their home. Now, first of all, what's equity? All right, the equity is just the appraised value. Um, well, it's the difference between the value of the home and the amount that's owed. So if your house is currently worth $200,000 and you owe $80,000 on the house, then you have what's called $120,000 equity in your home. Now, banks will usually lend up to 80% of that. This problem right here, we're using a number like 70% for some reason, but that's cool. So, all right, so let's see what we got. This couple purchased their home 14 years ago for $95,000. The home was financed by paying 20% down and signing a 30-year mortgage at 9.95% on the unpaid balances. Equal monthly payments were made to amortize the loan. The net market value of their house is now $140,000. That's going to go right here. After making the 168th payment, we're going to see what they owed, and that's the game plan. So first thing we need to do to be able to get this information in our calculator, or information solved by our calculator, is get the information in TVM Solver. So let's do that. So N is, and again, we're dealing with the initial. Granted, this was 14 years ago, but for us to set up the payment, we need to work from the original agreement with the bank, which is based on 30 years. So we're going to have 30 times 12. And again, I like to go ahead down here and just set up the 12 while I'm thinking about it. The interest rate is 9.95. The present value, so they paid $95,000, but they were required to pay 20%, right? Yeah, 20% of the $95,000 as a down payment. So they end up borrowing $76,000. Now we can calculate the payment. So their payment would be $664.15. So the only reason we do that is so we can use the balance key on our calculator to find this value right here, the amount owed. For the balance key to work, For the balance key to work, this has to be stored in our calculator. So now that we've got that, we can go second function quit, apps, go to the balance key, and we want it after the 168th payment. So the balance owed on the house is $63,689. So this is the amount owed. To find the equity, we need to come in and find the appraised value or the current value of the house, which is $140,000. And keep in mind, ladies and gentlemen, that they are only going to get 70% of the equity. So I'm going to go ahead and take this. So I'm going to subtract this number from 140,000. And then I'm going to multiply by 0.70. So the amount that they would get would be what, $53,412. Okay? No, $417. So that's how much they would get. That's 70% of the equity. So, if they wanted to, why would you ever do something like this? Well, maybe you want to take a trip. Maybe you want to use the equity in your home for college tuition. Um, Maybe you want a new car, because typically you can get these loans at much cheaper than you could get a car loan. Plus, this is tax deductible, and a car loan isn't. So, there's reasons to do that. And there's reasons not to do it. So, all right, a business loan for 500,000 carries an interest rate of 7.2% compounded monthly for 10 years. The business decides to pay interest only. Okay, this is interesting. For the first 3 years and repay the loan amount plus interest in equal installments for the remaining 7 years. All right. How much money will be paid each month during the first 3 years of interest only? Well, guys, that's pretty simple. If we do interest only, we can calculate the interest. So we have 500,000 times 0.072. So that's going to give me the interest each year, and I can multiply that by 3 to figure out the interest that they'll pay for 3 years. So they're going to pay $108,000 interest over the first 3 years. Well, I can divide that by 36 for obvious reasons, and see that the monthly payment is $3,000. So all I have to do is just use a simple interest formula. Interest is principal times rate times time to get the interest paid, and then of course divide that by 36. Now, what you're essentially doing is you're paying the first month's interest the entire 3 years, because you're not decreasing your principal whatsoever, so your interest remains constant because it's always on the full amount of the loan. Now, 3 years later, for the last 7 years, they actually want to do a traditional amortization. In that, you pay not only the $3,000 interest, but you want to pay extra to chip away at your principal. So this is going to be really simple. So we're going to have for 7 years. Come down, 12. It's good. The interest rate is 7.2. The present value is 500,000. And is that 500,000? Got enough zeros there? Yeah. And the payment is going to be $75.95.32. Now, I didn't ask this in this problem, but let's think about how much interest would they pay if they did this. Now, I want to look at another interest too. So I'm going to teach something more than just doing the problem here. So how much interest did they pay by doing this? Well, they paid $108,000 plus these payments. So they're going to pay a total of I'm going to break it down this way because, again, I'm teaching and not just doing. So you're going to pay $3,000 times 12 times 3 plus they're going to pay 7595.32 times 7 years times 12. Now, if I subtract out 500,000, which is the principal, I have to get the interest paid. You can always find the interest paid by taking the total number of payments, the total value of the payments minus what you financed. That has to be the difference, has to be the interest. So 246,000.88. All right, now, what if they had just decided to pay interest and to reduce the principal for all 10 years? How would that have changed things? Well, it would have been advantageous for the company to do that because it's going to actually cost less money. So for the 10 years total, right? 10 times 12. Again, come down, make sure we got 12 and 12. Interest rate is 7.2, 500,000. Our payment would be $5,857.09. Now, if they had done this, they would have paid $58,057.09 times 12 times 10. They would have made total payments of $702,850. Subtract out the $500,000 that you for your principal. The interest paid would have been $202,850.80. Now you might say, well, if you're running a, I'll tell you what, let me see if I can make this clear. If you might say, well, if you're a good business manager, why in the world would you do the interest only for 3 years and then put your payments toward principal for the last 7 when it costs the company $44,000, $43,000? Well, things like this happen. Maybe what they're getting the business loan for is regularly $750 or $1 million, but because of their cash flow, they couldn't start paying the extra amount for 3 years. But maybe it's a piece of equipment that they got a super good buy on, and they had to go and buy it, but they couldn't afford to make the full payment until 3 years later because maybe they had some other things going on. So you never know. I mean, running a business is, just depends on different factors. I remember when I was part owner in a golf course, we bought some new golf carts. I think I've told you guys this before. I forget, we bought 20 golf carts. I forget exactly. No, I know we didn't. We bought 25 golf carts. And I know we borrowed a lot of money. Well, we always had our payments due in August. Reason being, in Kentucky, the golf business, that's when you've got the most money after the golf season. So, all right, gang, is it more profitable to receive $3,000 at the end of each month for 10 years or to receive a lump sum of $45,000 or $450,000 after 10 years? Money can earn 3.2%. Well, gosh, this is easy. There's nothing to even compare, really. So let's just plug and chug. So at the end of each month for 10 years, so 10 times 12. Go down, make sure we got 12 and 12. The interest rate is 3.2. Our beginning balance is 0. PV, that's actually present value or beginning balance. Payment is $3,000. And the future value is what we want to know. So, drum roll please. Is it bigger than $450,000? No. So guys, you would want to wait until the end of the 10 years and take the lump sum value. All right, gang, so I've got, this is video number 2 of 3 videos, more on annuities. Take care.